To all of you. I am C. Indrajit Kaur Bamra, the moderator for this webinar. On behalf of the Valuation Standards Course of I would like to express our sincere gratitude to each and every one of you for taking the time to join us today. A very warm welcome to all the participants joining us for the Valuation Manthan Session-7 covering the approaches and models. So, I would like to welcome our chairman, C. Hansraj Chukji, who is also the Central Council member of ICI, to share his words of wisdom with us.
Thank you, Inderjeet. Thank you very much. Friends, I welcome you all to this journey of continuous journey of this program, Valuation Manthan Series 7 today. And actually, the idea behind it, you all know, learning is a continuous process. And naturally, the subject which we talk about, the valuation, which carries so many positivity and somehow some challenges also. And naturally, the guidance comes from our speakers. So many doubts which remains in our mind. So many forward-looking statements which we expect to come forward from the speakers. And today, fortunately, we have a friend from our own profession, Vikas Goelji, who hails from the Gurugram and having a vast knowledge. He is an expert into this area and have been really been a part of the valuation standard board as a special invitee also in the board. So with the process, we understand with today's subject is approaches and methods. The standardization of the approach and the methodology, that is the must. You see, like once we talk about anything to be done with by any professional community, if standard approach are being followed with, the methods are also equally standard. So naturally, it gives a some kind of the key. It's a profession which carries some kind of the standardization and some kind of the good to be taken forward. So with those kind of methodology institute and the valuation standard board has brought so many standards which are mandatory to be followed by the chartered accountants who carries the valuation activities, who carries the valuation profession. So they have to compulsorily follow those kind of these standards. And today I'll request Vikas Goelji for his, I'll request Inderjeet to share his biodata or rather profile to each one of the participants. And then Vikas Goelji will be taking us forward the journey of the how the approaches and methods to be taken forward while performing our duty as a valuation professional. I welcome once again to each and every participants from the nook and corner of the country and some beyond the border of the country even, because this is a webinar. Webinar has no boundaries. Once we talk about the globe is one, so we are also one, whether sit our professional brothers and sisters sitting in our country or beyond the country, or everyone is being taken care by the as far as the knowledge sharing is concerned through the webinar mode. So with this words, I welcome each one of you once again. My co-chairperson, she may be joining at a little later. She is Preeti Savla from Mumbai. She may join at any moment. She'll be also sharing some words of wisdom with each one of you. But with this initial remarks, I welcome each and every participants. I welcome the speaker of the day. I welcome the office, our team at the office also, Dimple and the Rahul and the Inderjeet Kaur, the moderator of this very program, and tax sport, which we coming from the our outsource agency. Welcome each one of you. Over to you, Inderjeet.
Thank you so much, sir, for having enlightened us with your pearls of wisdom, and your profound insights and expert acumen are indeed immensely cherished. So, as our esteemed dignitaries have shed light on the topic at hand, so it is now our privilege to introduce speaker for today's webinar, who will share their valuable insight on the matter. Sir CA Vikas Kumar Goyalji, and I will welcome him with the brief introduction. As Vikas Kumar Goyalji is a chartered accountant and he's an academician with AIR in CA, CS, and CMA examination, and he is having more than 15 years of experience in finance domain, including Big Fours, and Sir has expertise in the field of financial management and business valuation. And he's also a registered valuer. So I would like to everyone to welcome Sir on the for the webinar. Very welcome you, sir.
Thank you. Chairman Valuation Standard Board and my friend CA Hansraj Chugji. The team from Valuation Standard Board support ICI, moderator Inderjeet Kaur, Dimple Kaur, Rahul, tech support, and all the participants across India, outside India. Thank you so much for giving me this opportunity. And whatever the small knowledge, little knowledge I have, I'm getting a chance to share with all of you. This is a great privilege for me, and this is a learning opportunity as well, because it's a two-way process. And as I learn, I share, I'll get the insight from all of you by any of the questions or any of the experience all of you have. Believe me, friends, valuation is a great opportunity for the profession, and day by day it is increasing. So when we talk about any of a new company, new startup, new funding, this is a vast area, and every business today for the expansion reach out to the investors and try to get the funding. So when we talk about a funding, the first thing comes in the mind at what value there should be a funding. Each and every business or each and every asset we call in the valuation word, we call it an asset which create the value, is valued at a point in time when you need a funding, or even if there is another objective to it, whether you want to dilute your stake, you want to monetize your asset, you want to expand, you want to merge with the another entity, everywhere you need a value. So friends, when we talk about this subject, it is a vast, and when we learn, get the insight what should be the value, then first thing comes into the mind, how should we value the asset? And then it comes, the next question comes, is there any standard processes, is there any standard methods, is there any standard approaches that need to be followed? So today what we are going to do, we are going to, so always there is a saying in the valuation, whether valuation is a science or the art, definitely it's a combination of both. But when we talk about a standard processes, standard approaches, it is more of a science that you define a particular process, and then it is followed by the experts, by the valuation experts, or by the businesses. So what we are going to do today, in my presentation, I'm going to cover the defined approaches and methods, which is issued by the Institute of Chartered Accountants of India in the Valuation Standard 103. And then we will learn what are those approaches and the methods, and then we will cover some case studies based on these methods and approaches. Believe me, it's a very vast subject. In 2 hours, it's very difficult to cover each and every approach and methodology, but we will try to at least get insight what are those methods, approaches, and out of those, what are the significantly important and commonly followed in the valuation world. So I'll cover in my presentation these methods, and then we'll take certain questions, and then we'll do a case study. So this will be the structure. I would like to share my presentation just for a moment. I hope this is visible. Thank you. Okay, so Valuation Standard Board of ICI has brought certain valuation standards, out of which 103 is one of a very, very important standard, which covers approaches and the methods. So as I mentioned, that as we go into a deep subject, there has to be some defined processes and methodologies, so that it gives a guidance to the people who are in this field. So this 103 standard covers the valuation approaches and methods to give the guidance to the valuation experts, and this covers the entire methodologies which are defined as of now, which need to be followed by the professionals, and then the application is to be in their valuation assignments, and to value the financial assets primarily. Now look at what are the approaches which are defined in this. So let's not go into the valuation standard, but in a general, if we think about what can be the methods in a general, or what can be the approaches, so there may be a different kind of a methods can be followed. But when we talk about broadly how we can divide these methods into a different approaches, one comes to the market approach, where we compare with the market factors, market parameters to value a particular asset. It can be the market means the company's own parameters which are defined in the market. If a company is listed, definitely the prices are on a daily basis. There are the prices listed on the stock exchange. You can follow those parameters. Number two, if the company is not listed, then you can compare, you can find out the similar or identical companies in the available in the market in the listed space, and then compare the parameters of that particular company, and then value the shares of the company which you or the valuation experts are valuing, or the business are valuing. So it is, I'm not differentiating who is the valuer, but even if the business wants to value themselves, they need to follow certain approaches. Definitely valuers need to follow the approaches and the methodologies. Then if there are no comparable companies available, like in case of the startups, generally the parameters are not available from the listed space, and or available with a very much deviations there. Then what you need to do, you need to compare with the recent transactions in that particular space. Maybe similar kind of a company which has got funding with a particular uh, size, with a particular, or in the similar kind of the business, those parameters can be considered. So these are the market approach, and these primarily divided into three categories. One, we talk about market price method, then comparable companies method, comparable transactions method. When we go into the next approach, which is income approach, now income approach is specifically use the parameters of that particular company or the asset which we are going to value. This income approach is primarily to derive from the business, the value from the business itself. And the most followed or most popular method in this is the discounted cash flow method. What is this method? We are going to take this into detail because this is one of the most important method followed across businesses and much reliable. I would not say reliable, but much followed, authentic, and which is coming from the business itself. Then there are certain other methods into income approach which are primarily used for intangible assets like relief from royalty to value a brand. Then multi-period excess earning method. This is again to value intangible asset with or without method. Option pricing methods. So these are some different approaches. Now in income approach, when you are going to value a business, then primarily the discounted cash flow method is very, very important. Number third approach, now market and income. These are two different approach. And then when we talk about what may be the another approach which can be followed for the valuation purpose is the cost approach. Cost approach, there are two methods defined, and these are based on the research work across. It's not only in India, but when we talk about international standards, these are the approaches which are mentioned over there also. Cost approach, primarily two approaches has been defined. One is the replacement cost method and reproduction cost method. Replacement, the name suggests when you replace a particular asset, what will be the cost? Like for an example, if I talk about a machinery has a particular cost, and when we are going to value an existing machine, then there may be a replacement cost method which we can follow. That what will be if we replace this machine, what will be the cost available as of now, and then we can do certain adjustment to that, like what is existing machine has a physical obsolescences, technical obsolescences, those adjustment can be done to that. Then reproduction is where there is not a replacement, but it is basically a build kind of the approach which we take. Like for an example, a plant is not just one machine. It take lot of time to build it, and there are a lot of factors into this. So when you value a particular plant, then you need to think from a if you rebuild it, what will be the cost to this? What may be the loss of the business? Those parameters also may be factored in. So this is the valuation approaches. These are the valuation approaches broadly divided into three, and then the methods. We are going to take a little detail of all these methods. Now, as I mentioned, the market approach is basically largely from the transactions available in the market or the comparable businesses available in the market. And this approach is followed where the price is available in the market and common size businesses are available in the market. For an example, if I say we want to value a company which is into a space of, let's say, automotive, or maybe let's say in the space of electric cars, a company in a private space. Now you need to see how we value that particular asset or a company in the market. We need to find out whether the comparable companies are available in the market. Yes, definitely comparable companies are available in the market. Then we need to factor in certain parameters. What is the size of those companies which are listed, and what is the size of the business which we are going to value? Other factors, definitely available in the market is the capital structures, their performances, capacities. All those are the factors which we need to consider to apply this method. The problem is in this method is the to find out the comparable companies, and it is not an easy task because there may be multiple companies available into particular field, but then you need to find out what are the outliers which we cannot consider and what will be the comparable companies to follow this approach. Now, as I mentioned previously, there are three methods to this: market price method, comparable companies method, comparable transaction multiples method. Market price method is basically, I'll give you an example of this. Let's say a public limited company wants to issue further shares, or maybe private placement through QIBs. Then there is a rule from the SEBI that the price, there may be a floor price and then discount available or allowed by the SEBI. In that case, the last 2 weeks average price has to be considered. Okay, so market price method means if we are valuing the same company over a reasonable period, then from the active market, what is the price of those shares need to be considered from the same company pricing. Comparable companies, then in this space, as I mentioned, from a publicly traded companies, we can find out multiples, market multiples. Now market multiples, what are the market multiples? Primarily the enterprise value to sales, enterprise value to EBITDA, enterprise value to or the equity value to PAT, or maybe PE ratio. These are the comparables. We'll take all those comparables for valuing the companies in the similar space. Then comparable transaction multiples. This method is little complex, or I would say, because comparable transactions are not generally available in the public market. These are available through certain available databases, where you find out what are the recent parameters or recent transaction multiples in the similar kind of the companies, and those multiples are generally considered for valuing the transaction or valuing the asset. So these are the three methods in the market approach. Now, what will be the process of identifying or using the market approach? Number one, so these are the stages where we can follow how to use this market approach. First, find out comparable asset, then market value of those assets. Now, after market value, apply the multiples. EV EBITDA is one of the most important multiple across businesses. This is used because EBITDA is the most important factor for the operational efficiencies of a company. Then EV revenue. EV revenue is less popular, but those companies where there is no positive EBITDA, generally EV revenue can also be followed. P multiple is generally to calculate the equity value of a company. P is price earning ratio. Then compare these comparables and understand if there is any need to the adjustment, like size of the company, like not exactly in the same business, but to be in the similar kind of, or the vertical or horizontal kind of a business, and then make certain adjustments, size, then geography, then the nature of the business. All these adjustments we need to do in this, and then these adjusted multiples parameters are applied on the asset which the valuer is going to value. And based on those multiples, what will be the range? Now, it is not exactly one multiple which is used. EBITDA, revenue multiples may be different, and then the range can be arrived. Based on that range, we can use either the average if the range is not significantly large. Range has to be within a considerable range or reasonable range. It cannot be the terminus like 1 to 100. It has to be within maybe considerably 10-15% variation can be considered, but not more than that. And then average of these values can be considered. Now, certain transaction multiples which are used, as I mentioned, EV sales, enterprise value to sales. These are the multiples which are used in the businesses, primarily where there are no profits or EBITDA is not positive, or the early stage companies where company is growing and does not have us a reasonable profits. Then EV EBITDA, which is the most commonly used multiple, those stable companies, even if in the growth phase also, but mostly those companies which has been proved into the business, which are stable, are generally used EV EBITDA multiple. Price earning ratio is, as I mentioned, it is for the equity value, because earnings are primarily for the equity holders, and therefore it is considered to be the equity value. Price to book, not so popular, because book value is always a different. Net worth, it is a comparison of a net worth to the market cap, but can be used as the benchmark, but not to be the sole use of the transaction multiple. Now, these are not only the multiples which need to be considered for the valuing of the company. There are certain specific companies where the specific multiples need to be considered. Like, I'll give an example like hotels. In case of the hotels, it is not always useful to consider only the revenue to sales or value to sales, EBITDA or price earnings. In this is a capacity driven business. So in case of the hotels, number of rooms available to the to the enterprise value can be considered, because ultimately when we value a particular asset, we need to consider what may be the synergies can come from the acquisition, and the room capacities can be considered to this. Then, like in case of the power companies, again, this is kind of a capacity driven business. What is the megawatt capacity of that company? And that can be considered as the factor for enterprise value. Similarly, in tower companies, how many towers, what is the capacity, that can be considered. In case of the recent SES based companies, it is generally considered to be the annual revenue multiples. So the first method I mentioned, enterprise value to sales, this is again the similar kind of, but in SaaS companies, the average recurring revenue is considered to be. It is not one time, but recurring revenue. So last 12 months revenue can be considered for valuing a company. How many multiples? And then e-commerce companies, GMV. So GMV has always been, the factor earlier for e-commerce companies. Still, this kind of a method is considered, but the situation of valuing companies and their fall has given a lot of questioning on this method. So these, I mean to say, these are the other popular methods or the multiples which are followed across different industries. but the most popular multiple is considered to be enterprise value to EBITDA. Now, there are certain factors which are also considered while using the multiples. So these are the factors in the valuation standard. These factors are also covered. One is lack of marketability. In case of the private limited companies, generally, when you buy an asset, you do not have the flexibility to sell on the next day or maybe couple of years, because there is no marketability of those shares available or flexibilities available to the investors. In this particular case, what is considered to be that when you buy, the buyer do a discounting of this factor, that he is having a less flexibility. But again, this depends upon the who is buying your business. If it's a strategic buyer means a person who has a business, similar kind of a business, or who want to gain from a synergies by acquiring your business. In that particular case, this discount factor may not be applicable, because ultimately the synergies will play an important role. Then there may be a lack of control. Now, in case of a private limited companies, there are two kind of the acquisitions happen. One is minority stake, or where the control is not there, or another is the control transactions, where the control is there. Control means when the buyer has the right to restructure management, buyer has the right to implement certain financial business strategies. So those transactions, which are the control transactions, has a plus point for the buyer, and the buyer is ready to give the premium on those transactions. Generally, the premium has a range, and that range comes from business to business, buyer to buyer, and it can range anywhere. So those transactions, now in this control transactions, the premium is always based on who is going to buy and how many buyers are available, what will be the synergies available to the buyers, and then the buyer can go up to a particular extent of the premium. But in case of lack of control transactions, where the control is not given to the management, in that particular case, the buyer can ask for a discount because it's not a control transaction. But when we are doing a valuation, we are not considering a specific kind of a discount. But if it's a control transaction, definitely a control premium can be assigned to it based on the parameters available. And these factors are generally based on what has been the transactions in their different geographies, in the different business space, what may be the market opportunities, market growth of that particular business. So these factors are basically subjective factors, and the judgment of the valuer is very, very important in this space. So this is again some kind of the formula or the guidance available to calculate discount on lack of control, and it's a simple reversal of kind of a premium. But as I mentioned, the premium and the discount, it's a range based on the volume and based on the transaction, the size of the transaction. This is again a lack of marketability, and this is based on the negotiation. It's not based on the valuation approach, but there may be a lack of marketability. Discount can be applied. Now we'll move to the next approach, which is the income approach. In this, as I mentioned previously, discounted cash flow method is the most important method which is used for valuing any kind of a business, because it is actually based on the business insights, how much cash the business can generate over a reasonable period of time, and then you apply a discounted present value of those cash flows, and then you calculate the value of a business. This is very important method, and across industries this is followed. In this method, the name suggests discounted cash flows. So discounted cash flows, for this we need to calculate cash flows first. And what are the cash flows? Cash flows are basically the generation of the funds from business activities. When we talk about a business, first we calculate revenue, then we calculate direct cost, then we calculate gross profit, then we reduce the operational cost, we come to the EBITDA, earnings before interest and tax and depreciation, and then we reduce the depreciation and interest. When we reduce the depreciation, we come to the EBIT, EBIT. When we reduce the interest, we arrive at the EBT, and then when we reduce the tax, it comes to the profit. Now in this, discounted cash flows means we need to calculate the cash flow generated from the business activities, and that can be maintainable in the near future. Now there are a lot of confusions in this calculation of the cash flows. Number one, whether we need to consider any exceptional items for the future. No, it should be a normal business profits. CapEx need to be considered. Yes, CapEx is the investment, and cash flows, for calculation of the free cash flows, any capital expenditure has need to be reduced from the, because apart from the, if capital expenditure will not be there, there will not be a generation of the funds. So it's a need of the business. Then is there any other income which is generated from the surplus funds available need to be considered in this? No, because we are calculating the enterprise value. Any surplus income from the investments will not be part of it. Interest cost need to be considered? No, because we are calculating the enterprise value from the discounted cash flows. This need not to be considered. Okay, so we'll cover now discounted cash flows. What are the three important aspects into this method? One is calculate the cash flows, then apply a discount rate, and then calculate a terminal value. So these are the three important factors while valuing a business based on the discounted cash flow method. So once you calculate the cash flows, your work is half done, or the most important part is done in case of this approach. How you will calculate the cash flows, whether we should consider the projections given by the management. What are the sources of calculation of the cash flows? Very important question. Now management may be very bullish on the cash flows. We need to consider the reasonableness in the cash flows, and if there is any aggressive cash flows, what are the assumptions, what are the factors taken into consideration? In the normal case, if suppose historically the company has grown 10%, 15%, and in the future the growth has been taken, let's say 50%, what is the basis of the 50% growth? That has to be considered. It is not simply the forecast or the assumptions or the cash flows submitted by the management. There has to be a reasonable diligence on those cash flows, and assumption has to be documented. When we calculate the cash flows, then we apply a discount rate. Discount rate is generally, we use the discount for calculation of a discount rate. We use the cost of equity or the cost of capital if there is another capital structure has, apart from equity, it has any other source of funding, maybe preference shares, maybe debt, then we use the discounted cash flow method. Discount rate, weighted average cost of capital. In weighted average cost of capital, first we need to calculate the cost of equity. For calculation of a cost of equity, we follow, or a guidance is given to follow the CAPM method, capital asset pricing model. That means it's a defined formula where we use the risk-free return and then apply a risk premium to it, and we arrive at the cost of equity. We'll see this formula in the coming slides, and then we calculate terminal values. Why there is a consideration of a terminal value in discounted cash flows? So generally the approach defines that discounted cash flow method you follow in estimation of the cash flows for a reasonable period of time, let's say 4 years, 5 years, 6 years, or up to 10 years. If there is a consistent growth, or if there is a variable growth, and you can estimate up to a particular number of years, then we use, if the business is perpetuity business, then we use a particular terminal value that with a constant growth, the company will grow up to a particular number of years, and then the terminal value is considered to be the value at the end of the estimated cash flows. So let's say we estimated up to 5 years, and then after the 5 years we consider to be a constant growth in the business, and then we use the terminal value. For terminal value, the most important formula is the Gordon's growth model. Gordon growth model is very, very simple. It says if you have a constant growth, then you can apply this formula and you can arrive at a business value. So suppose even if today I say I have the earning from the business, or maybe cash flow from the business is 100, let's say, and these cash flows will constantly grow at 5% going forward from today onwards. What is the value today of that particular business? The Gordon's growth formula says you need to, if you want to use a terminal value, or you want to value a company which has a constant growth, then the next year cash flows divided by KE minus G, cost of equity minus, or cost of capital minus growth, that need to be applied in this particular calculation of. So this formula, Gordon growth formula, can be applied when there is a constant growth. Then there are other methods also. Variable growth model. Variable growth model means when there is a variable growth happening, after that you can apply this. Maybe it can be reducing method, it can be increasing method, then exit multiple method. Generally in the startup space, it says after 5 years these are the cash flows, and after 5 years the multiple of business will not be based on the Gordon's growth formula. It has to be based on the multiple of the EBITDA. What will be the last year EBITDA, and then you apply the multiple of EBITDA, you will get the exit multiple, exit value of that particular business, and then liquidation value. If you liquidate that point in time of the business, what will be the value? So these are the 3 pillars of the discounted cash flow method. When you arrive this, your value is available to you. These are the process. You need to consider the projections, you need to analyze the assumptions. It is not simply the management which says, you need to assess the reasonableness of the cash flows, and then you need to calculate the discount rate, what will be the growth rate, and then you need to calculate the present value, and you will arrive at the enterprise value of the equity. At the end, we have a case study to this, and then we'll see how these projections are there. If there is any unreasonableness, we need to consider, or we need to stabilize. If we apply a particular discount rate, what will be the value of the business? In this discounted cash flow method, uh, it has a detailed process and lot of judgments, lot of analysis involved in this method. You cannot simply consider the business plan of a company. You need to also go through the historical financials, profitability, if the company has been stable. And then you need to apply what are the market factors, what is the go-to-market strategy of the company, and what will be the parameters based on which the value or the business plan has been built. What are the assumptions? So both qualitative and quantitative analysis has to be done on the business plan. And then projected financials need to be analyzed, and based on that, free cash flows need to be calculated, apply the discount factor and terminal value, and then DCF value is available to you. So I'll pause here, and if we have certain questions, we can take questions meanwhile, and then we can move on. Indrajit?
So there are some questions from participants. First one is, if for a private limited company, we want to issue private placement of shares with premium, then in this case, whether valuation need to be done from certified valuer only?
Okay, so this question is primarily based is the requirement of the Companies Act. So Companies Act says if a company is issuing these shares, there has to be a valuation, and it has to be from a chartered accountant or a registered valuer. So it can be by the chartered accountant as well.
Thank you, sir. Second question is, can NAV method be used in valuation of shares for repatriation of ODI?
Sorry, can you repeat?
Can NAV method be used in valuation of shares for repatriation of ODI?
So NAV is one of a method. So NAV is the net asset or the net worth of the company. Generally, if the shares are issued at the price, NAV can be used, but it is not the sole method. If there are cash flows and you want to value a business based on the cash flows, it can be based on the cash flow methods. So NAV is one of a suggested method which can be used. It is not necessary that you follow another method, but for ODI also, it's based on the valuation guidance, and the valuer has to use a particular method. NAV is a suggested method given in this valuation guidance, so can be followed.
Question is, how goodwill is to be valued during pendency of insolvency petition?
Okay, so in case of the insolvency, first goodwill valuation of a goodwill is based on primarily the cash flows, and when there is a pendency in the NCLT, and operations are suspended, there is no specific value is assigned to the goodwill at that point in time, and there is no specific guidance available. But goodwill is also part of the assets, and when we calculate the business valuation, goodwill has to be calculated as the remaining of the uh, value of the business after assigning the values to the other assets. So it is considered to be the value of the business less value of the individual assets. So this is a fundamental approach which is followed. But in case of insolvency, generally good separate assessment of the goodwill is not carried out.
We are moving to our next question. Question is that in a startup, especially when it's pre-revenue stage,
Right.
although there might comparable transactions like sales, EBITDA, PE will not be available. Then how to value the enterprise for capital infusion by way of private placements or right issue, and how to justify income tax, FEMA or NCA regulations.
So as I mentioned, in case of the startups, it is not always the parameters which are followed like EBITDA or P multiples, but the other methods which are generally followed are the revenue multiples can be used. Number two is the discounted cash flow method. It is so ultimately in case of the startups, there has to be a management assessment and cash flow calculations. So those cash flow discounting method is generally followed in case of the startups and their revenue multiples. And it is not something that you convince to the FEMA, you convince to the income tax. It is the business which and the valuer based on the assumptions and the approaches which you follow, which are scientifically accepted. So in those cases, you need to follow the discounted cash flow method, and then revenue multiples can also be considered, because definitely everybody understand that EBITDA is not positive and the profits are not available in the company. But every business has the value. It is not something that if the profit is not positive in the current year or maybe in next couple of years, but based on the growth and the business plan of the company, there will be a positive cash flows going forward, and you apply a discounted cash flow method for these valuations. So discounted cash flow method is one of universally accepted in all such cases.
Thank you so much. Our next question I would like to take on the behalf of the participant. It's like a case study. So, for example, I purchased a house property in 1999 and sold it in May 2023. And I have option to substitute the cost by valuation on 1st April 2001. Since I incurred stamp duty in 2003, will it be taken into account for valuation or else? And can I take it as a cost of improvement and apply cost index from the financial year in which stamp duty was paid for registration?
So this is I don't think this is a question for valuation, but a question for applying an indexation, right, from an income tax perspective. So in this, I think my view is that indexation and the cost of acquisitions are considered to be the cost of acquisition or cost of improvements, and indexation will be available. So if the stamp duty is paid in 2001 for that particular asset, it can be considered for the indexation.
I think the participant get his answer. So thank you so much, sir, for answering the questions. The rest of the questions we will take after an hour or half an hour. So you can continue the session.
Okay, thank you so much. Okay, so we were on this screen. So as I mentioned that discounted cash flow method is one of a very important approach and is scientifically considered to be a very, very important method in valuing any kind of a business. So when we calculate a value of a business, considering other market approach, any other method, discounted cash flow method is considered to be a more scientific to compare with and most important method. So I'll give you an example of a real life valuation. When private equity funds do the investment in the companies, so generally they do an investment in growth opportunities, and they find out certain businesses which, let's say, today is X, and in a 3 or 4 years time period they can give them 2x or 3x kind of a return. So what they do a valuation benchmarks. They do a valuation benchmark based on the market multiples, but simultaneously they use the cash flow discounting method. Why they do so? They also analyze for their financing options. So if the company is generating funds and those funds can be considered for dividend to them, what kind of a financial arrangement for this kind of the investment they can consider. Okay, and accordingly the value of the business is also arrived based on the cash flow discounting method. So in case of the private equity investments, they do consider the market multiples, but cash flow discounting is very, very important for them. And cash flow discounting gives two kind of a comfort to any of the investor. One is how management look at the business, what are the business growth opportunities available, and how can a firm or the business can generate cash flows. So this actually, the plan of the business gives the lot of insight, lot of information to any of the investor, and then they can follow or they can benchmark, or maybe subsequently they can look at the progress of the business. So cash flow discounting becomes very, very important. So now when we do how startups get their value, definitely startups do their valuation based on maybe multiples, but the one of the most important method which is followed in the startups also is the cash flow discounting method. In some time, the business plan may look like very aggressive. Let's say today we have a startup has come up with some kind of a cash flow or revenue of, let's say, 100 maybe 10 crores, and next year the growth has been taken 2x 3x, but those there must be some assumptions to it, there must be some factors to it, and then this approach has to be followed. So in case of startup, cash flows quickly increase based on their go-to-market strategy, based on their investments, and based on their customer acquisitions. So in case of the cash flows, there are generally two different approaches which are followed. One is the cash flow to the firm, free cash flows to the firm, FCFF, and FCFE. FCFF is basically to calculate the enterprise value. In this, we ignore what is the capital structure of the company, and even if there is a debt, the interest cost is not considered for calculation of the free cash flows. In this case, basically the business free cash flows to generate the business income are considered, and interest cost is not considered. Next is the free cash flow to equity. Free cash flow to equity is the cash flows which are available to equity. In this case, the interest cost is reduced, and the cash flows available to equity shareholders are considered. In this case, the value of the equity will be arrived by discounting. So in the first approach, FCFF is capital structure neutral cash flows, and FCFE only equity cash flows are considered. How? So basically there is a basic difference in the FCFF. Interest cost is not considered, or cost of any specific capital structure is not considered. In case of FCFE, the cash flows to equity are considered. So if there is any other capital structure available, the cost of that particular capital structure has been reduced from the cash flows, free cash flows. This is a kind of a simple structure. If you consider what is the cash flows to equity, what is the cash flows to firm, in simple terms, cash flows to firm is before any cost or outflow on account of the capital structure, maybe borrowings, loans, etc. But in case of the equity, the borrowings or the loans are reduced, and then free cash flows has been calculated for the equity, for the available to the equity holders. Why they do so? Then the discount rate is also different for the FCFF and FCFE. In case of the free cash flows to the firm, the weighted average cost of capital is used for discounting, and in case of free cash flows to the equity, the cost of equity is used for the discounting purpose. These we have already discussed. What are the assumptions? Product line, what may be the build-up, what are the investments, what are the operating margins, net working capital structure, net working investment in the working capital. These are considered to be the important factors while calculating the cash flows. Then discount rate. Discount rate is generally the CAPM which is used, or maybe if there is a benchmark that in a particular kind of a business there is a specific cost of equity has been followed, those cost of equity parameters can be considered along with the different risk profile of the company, and adjustment can be done. So like for an example, if I say a listed company has 15%, or let's say 15 or 16% of a cost of capital, cost of equity, and you are going to value a specific company with in the similar kind of a space, but it's a size is very small then compared to the listed company, then there may be an adjustment for the size, because small company has the higher risk. Okay, so risk appetite and risk inherent risk in that particular company can be adjusted. You can increase the risk premium, additional risk premium for the size, and get the adjusted discount rate. When there is a different equity structures, then we follow the weighted average cost of capital, cost of equity. Weighted average cost of capital is a very simple thing. Weighted average cost of capital is cost of equity multiplied by weight of equity plus cost of debt multiplied by weight of debt. So this is a WSCC considered for the discounting on the free cash flows to the firm. Now here capital asset pricing model is one of a very, very important aspect. As I mentioned, capital asset pricing model is the risk-free return plus risk premium of that particular uh, company and multiply by beta. Equity risk premium. Equity risk premium here, equity risk premium, if we multiply by beta of that particular company, it comes to the risk premium of that particular company. And risk premium is here, the risk premium multiplication is the market risk premium. Market return minus risk-free return is the market risk premium, and market considered to be the benchmark for calculating the risk premium of a particular asset. Then alpha, as I mentioned here, is a specific risk premium of that particular company. So when we calculate the riskness of a particular company available in the market for discounting purpose, alpha can be added for nature, for size, or any additional risk factor which can be considered for additional adjustment into the cost of equity. This is a kind of the CAPM formula which is used in the discounting, and the most easiest method available, risk-free return plus beta into RM minus RF. Risk-free return is the generally considered to be the government bond rate and available in the market easily. You can download from any of the source for the government securities, maturity up to 5 years, 10 years, 30 years, 15 years, and 10 years is a benchmark when we use in the discounting. Market return is considered to be Sensex or the Nifty long-term returns, historical when it was launched until today, what is the return of the market, and the risk premium from the market is the RM minus RF is the risk premium. And then beta is considered to be the specific beta of that particular asset, which is compared to the market sensitivities. So market movements and that particular asset movement is considered to be the beta. Beta is a relative risk factor of a particular asset in relation to the market. So these, when we apply these, we calculate the equity, cost of equity, and cost of equity is considered to be the discount rate for the cash flows. Now, this I'll not cover this in detail. It is to calculate the leverage. Like if a company is having the capital structure of debt and equity, then what will be the beta of that particular asset class? So generally, how beta is calculated? Beta is calculated from the market comparatives. What is the market comparable company in the listed space? What is the beta of that particular company? What is the capital structure of that particular company? If that company is comparable with your company where you are going to value, and if the capital structure is all or is kind of a similar, if the capital structure is not similar, then you need to do the adjustment for the capital structure and need to arrive at the beta of your leveraged company or unleveraged company in that case. So this is a kind of a calculation of the adjustment of the leverage in calculation of a beta. This I'm not going. This is a simple benchmark. If beta is less than 0, it means negative. Beta is 0, it means there is no impact of the share prices or the leverage from the market. There is no relationship of particular asset to the market movement, which is also unlikely. Then beta is, so market beta is 1, which is considered to be a benchmark because beta is a relative measurement of a particular asset and compared with the market. So if beta is between 1 to 0, it means volatility is lower than the market. Market moves one, beta of that particular asset is, let's say, 0.5, it means that particular asset will move into the positive direction only half of how market moves. If beta is 1, it means it is closely to the market. If market moves up, that particular asset will also move up and in the same kind of a range. If beta is more than 1, it means that particular asset has a high volatility than the market. If market moves one step ahead, that particular asset will move more than one step ahead. So this is to calculate the relativeness of a particular asset in terms of the market. Now, next is the terminal value. As we discussed earlier, the terminal value is why terminal value is important in the discounted cash flow, because we cannot estimate the cash flows for entirety of the life of the asset. We need to follow certain number of reasonable years, and then if there is a constant growth, then we need to calculate the terminal value. Or maybe even if not the constant growth, we need to calculate the terminal value and then discount that terminal value for calculation of the present value of the asset. So terminal value is considered to be or calculated in 3 different methods. One is stable growth method, where we follow the Gordon's growth formula. Number 2 is the multiple approach. Maybe in case of the startups, generally it says that the growth after 5 years or 6 years, it is not going to be a stable growth. But we can use a multiple, like after 5 years, if the company will have a EBITDA, positive EBITDA, and then we can apply a particular multiple and arrive at the terminal value that point in time. So that can be considered for calculation of the terminal value. And then liquidation value. If the company liquidate after 5 years or 6 years, till when we have done. So in this case, maybe certain businesses like which has a specific life, specific capacity, like in case of the mining, in case of the road, in case of all those businesses which are like boat model, build, operate, and transfer model. So in that particular case, you have a specific life of the cash flows. In that case, you need to calculate. It is always advisable, better that you calculate the cash flows till the entire life when there is a definite life. If there is no definite life, you calculate the cash flows up to a reasonable time, and then you calculate the terminal value for the discounting purpose. So in case of a liquidation, after let's say 5 years, you calculate the liquidated value, what will be the asset, and if you liquidate the business, what will be the value for that particular business, and then use the discount factor and apply the discount free cash flows and arrive at the value of the business. This is a Gordon's growth formula. In simple terms, it is Gordon's growth model was earlier used to be a dividend growth model. So it used to say D1 divided by KE minus G. D1 means next year dividend divided by KE means cost of equity minus growth. So in that particular case, if say suppose today a dividend has been given of 10 rupees and next year the dividend growth will be by 5%. So next year dividend will be 10.5 divided by discount factor or the cost of equity minus G. Cost of equity, let's say 15%, then minus G means 5% growth. Your value will be 105 next year. Similarly, in this method, when there is a constant growth rate for perpetuity, then cash flow of last year growth by the constant growth rate divided by discount factor minus K growth. This will give you the terminal value. We'll use or we will see the case study for this calculation. Exit multiple, as I mentioned, exit multiples in case of, let's say, the startups where the valuation, you cannot apply the constant growth, because it is not something like 5 years or 6 years is the achieving the maturity cycle of the business and there will be a constant growth thereafter. It is not. So in that particular case, EBITDA multiples are considered to be one of the method, and use those multiples as the exit multiples, and then terminal value is arrived for that. In case of the liquidation, like as I mentioned, when there is no the definite life of the assets, and thereafter the cash flows are not considered to be a long term, and you need to liquidate the value of the business. So what will be the sale price of the available assets, what will be the liquidated value, that can be considered as the terminal value. But in case of the going concern, and when we value the startups indefinite life of the business, this is not considered as the value. Quickly, we'll use the cost approaches, and then we'll move to the case study. In between we'll take further questions, and then we'll move to the case study to get the flavor how how the valuation happens, and how the market multiples and the discounted cash flow method is generally used. So in cost, as I mentioned, there are two different approaches are generally used in the cost approach. One is the replacement cost, and then the reproduction cost. Replacement cost, when there is a specific machinery kind of the asset and it is replaceable in the market, then we calculate the value based on the replacement. What is the new or the replacement cost available in the market, and then we do the certain adjustment for the specific factors like physical obsolescences, technical obsolescences, and then the condition of the assets. What will be the additional cost can be incurred for maintaining that particular asset, and so this kind of the replacement cost method can be used. And reproduction cost is the another method when we need to build the similar kind of the asset. What will be the cost? So for an example, if I'll give you a very simple example. Suppose there is a kind of the infrastructure which is created, let's say for a academy. Let's say it's a badminton academy. Okay, badminton academy is a kind of a infrastructure which is created, and for creating that particular infrastructure, it takes, let's say 5-6 months for building the entire structure. It's kind of a building a plant, building up the infrastructure, and for that particular building infrastructure, what is the cost will incur in today's scenario, that can be considered as the reproduction cost. And if there is any adjustment related to obsolescence, can be reduced from this and to arrive at the value of the asset under value. So these are the two things. Now I have a case study. Before we move to the case study, if there are any other questions which we can take, and then we'll move to the case study.
So we have some questions, likely from DCF method. There are many questions participants have asked. The first one is how DCF method works for NBFC or bank.
Sorry, in the
How DCF method works for NBFC, non-banking finance company or bank.
Okay. So NBFCs or the banks, their valuation is generally based on the assets available with them. Okay. And assets under management, when we talk about what is their loan size, loan book. So this is one of the parameters which is considered. But when we follow the discounted cash flow method, we use the income and expenses and then value the similar kind of the approach. It is not something when if somebody has a question in mind that we cannot use discounted cash flow method for bank or for NBFCs. Absolutely wrong. The discounted cash flow method can be used there as well. So when we talk about if there will be additional surplus of the funds, then the company will earn additional returns. And those cash flows which are reinvested, those cash flows which are surplus from the business and reinvested in the business for additional earnings, those are considered as the cash outflows. But in case of the discounted cash flows, we considered the net inflows and the discount rate which is available as a guidance for those banks and NBFCs. The question or the doubt in the mind is always regarding if there is additional capital available, it is considered is reinvested in the business, whether we should consider that as part of the cash flow or we should consider that part of the investment in the business. Okay. When additional capital is generated from the business, if you will exclude those and discount the remaining cash flows, you will calculate in the normal case of the business. If you do not reinvest those, you can apply the discounted cash flow method in the normal cash flow projections and then arrive at the value of the business.
Another question is what will be discounting factor for change in management and its effect on manpower?
This consideration of the management is a qualitative factor, and generally the business there may be a change in the business dynamics. Like for an example, if there is a private placement or the private equity is investing in your business, discounted cash flows or the discount factors are or the cash flows are considered to be based on the management capabilities, management experiences, but it is not always the management will be constant in the business. There may be certain changes. So so the quality of the management can be given some kind of the premium. Okay, but in case of the cash flows calculations, the cash flow calculation generally based on the business and the management ability, and then so it is the consideration of the management is considered to be the part of the business plan, and then the discounted cash flow generally do not factor in any change in the management. If there will be any change in the management which is estimated at the time of the valuation, then the factor can be considered. So maybe, let's say for an example, uh, today we are going to value a particular business based on the cash flows, and cash flows depends upon a particular management team. If management team will not be there, the cash flows may be different. Okay, so that kind of a scenario analysis can be done if management team is not there. But generally the cash flows and the discount rate are based on the constant structure of the management, and uh, uh, and uh, and the continuity of the business. So these are certain assumptions which are considered for the valuing of the business. But if there is a evident that there will be a change in the management, then the cash flows are always estimated based on the change in the management, and then there is no separate adjustment in the discount rate is considered.
We have another question regarding startup. So it's how can a startup be valued using discounted cash flow method? Startups often experience multiple funding rounds like pre-seed, first round, second round, etc. And within a short period, and the valuations for each round can differ significantly. So, how can one effectively forecast and justify valuations at different rounds, both
Right.
at the present date and the future? First question is this. And second question, is DCF the appropriate method for valuing startups, or is there any alternative method that is more suitable?
So like I mentioned previously also, most of the startups are based on the valuation is based on their DCA, and this is accepted by the regulatories also. Now the challenge is in the valuation of the startup is that whether you correctly estimate the cash flows or not. So in your first question, whether the cash flows uh, based on which the valuation is happening has the multiple round of the investments, and there may be a different or a significant change in the valuation. Definitely. Why? Because when today, so even if let's visualize or imagine a situation of a startup. So today, if a particular startup does not have any kind of a structure, it is only in the idea stage. Now that particular idea to bring into a structure, we need to do, or the promoters or the those founders need to do certain things to bring the idea on the table to or on the actual on the ground. In that particular fund round, it's only the idea stage, and you get the value of your idea and funding only to establish that infrastructure where you can start your operations. Okay, still that idea has the value. Now definitely idea cannot be created on a DCF method. It's based on kind of certain parameters or minimum values which are considered to be the value of an idea. There is no cash flow, and nobody can calculate a cash flow for that. It is only the idea and the lead generation or the angel round. Now as you grow, let's say you started you created the infrastructure, now you started with the revenue generation also, but revenue is a very small but has the potential. Now that potential you bring into the spreadsheet. You estimate how much funds, additional funds you need, and what may be the range next 4 years, 5 years of that particular business idea or that particular business. In this, you estimate the requirement of the funds as well. Let's say today I need uh, additional 2 crores of the funds, next year 10 crores of the funds, and then thereafter I need uh, 50 crores of the funds. To bring this structure and to reach to the revenue of, suppose today 1 crore of the revenue to 1000 crores of the revenue. Okay. In this entire methodology, you calculate the additional fund requirement as well. So this is the pre-study, pre-calculation that you do the entire business plan according to your requirement of the funds. It is not today where you will invest everything and then you will start your earning from tomorrow. You need a funding in stages, and then you will value your business accordingly. So today, what will be the important factor? What is the requirement today, and how your business will flow? So next 5 years, what will be your business plan, and based on the different funding rounds and different capex plans. In that particular case, you build your business plan, discount it, and then arrive at the discounted value. There is no problem in this. And this is how the business or the startups value based on their different funding rounds. Maybe next plan, when you will be raising a next funding, there will be a significant difference because the revenue has grown from 2 crores to, let's say, 15-20 crores. And that has proven your model. And then there will be a additional growth based on your additional funds requirements and capex requirements. So in that case also, you factor in those requirements and then build up your business plan accordingly for next 5 years, calculate your terminal value and apply a discounted cash flow method. This is how you value your startups, and there is absolutely this is the normal method and how businesses do this. Next question was sorry, can you repeat next question? What was?
Sure, sir. Is DCF the appropriate method for valuing startups?
Absolutely,
Or
absolutely. Yeah.
So I think we have got great knowledge on startups for DCF and valuation. So I would like to take last question before we would moving forward to the case study. That based on the service platforms, recently the valuation of certain companies like Byju's, Swiggy, etc. were cut by nearly halved by certain institutions for injecting equity. So is there a need to adjust valuations every year depending on market conditions?
So valuation is basically based on your business plan. Okay. So there are two primary methods which are followed in the valuation. One is the multiples, and when you do not have your specific parameters or what I call it, when you have the available comparables, you apply those multiples. But the another, which is very important method, is the discounted cash flow, which is the conviction of the management. And every investor wants to look at all those convictions from the management, which comes into the cash flows. How you can calculate and how business will look like, let's say not today, but after 5 years. So even if out of 5 years, you say 4 years will be a negative cash flows, but 5th year will generate cash flow, and there will be a terminal value based on those. Then it gives the conviction to the investors. or the trust to the investors that this is how the management look into the business. So business plan is very, very important. Now business plan has to be updated on a regular basis. So let's say large funding has been based on a specific business plan. Now let's say today the scenario has got changed. Market condition has been favorable or maybe unfavorable. If the market conditions are unfavorable, definitely you have to adjust your business plan accordingly, and you have to show a realistic picture till now why there has been a deviation from the previous business plan, and what will be the remeasurement or recalculations to be considered in the current business plan, and how the going forward the market will look like, how your business will look like. So those factors has to be adjusted in the business plan, number one. Number two is why the valuation has gone down of all these startups is because number one is the aggressiveness in the market, available finances in the market. So earlier these businesses were very aggressive in the market, and the expansion opportunities were very large. Now let's say I'll give you an example like Byju's. uh, During COVID the situation was, or let's not take the example of Byju's, let's take the example of Zoom. During COVID the valuation was shooted to a large extent. Now the valuation has dropped significantly. Why? Because now the market is opening, the situation is getting better in the market, and the business plan has got changed. The market condition has been unfavorable to a particular business. People started physical conferences, people started meeting people, traveling started. Now this entirely has changed a particular business. Similarly, in case of the Byju's is aggressively looking to open many physical centers. Why? Because there is a change in the market requirements. It's not only the uh, only the the e-study which is popular now. People or the students wants to go to the physical centers, do a physical study, and this entire value chain has changed. So this is required to be incorporated into your business plan, which will definitely change your projections, forecasting, your customer acquisitions, your strategy, and then uh, the change in the business plan will get adjusted uh, in your valuation. Yeah.
Taking the questions from the participants, we have some more other questions also, but due to time constraint, as you have to discuss the case study, which will clear all the participants more, it will increase their
Okay.
practical experience. So before I'm giving the opportunity to share the case study, I would like to announce that to all the participants that we have feedback form that is showing on the webcast of each one of the participant screen, that is on the right side. Please fill that feedback form, whatever you want to share with us regarding the sessions and what changes you might want us to take. So please do share your feedback at the end. And now over to you, sir, for case study.
Okay. Is this Excel also visible?
No, sir.
Okay.
Now it is visible, sir.
Okay. So This is a kind of hypothetical example of a discounted cash flow, and the similar business plan is generally used for the market multiples. So for any of the business valuation, what we need as a valuer, we need a business plan, we need a historical forecast, historical project, historical financial information, and then the projections from the management. Okay, so this is a typical kind of a format where we have the profit and loss, we have a balance sheet, we have a cash flow, we have certain factors which are available, or which we do the analysis in terms of the parameters like key ratios, certain profitability benchmarks, and then we use the discount rate and then multiples to value a business. Now, in this, everybody would like to see that the profit and loss in a brief, we use the revenue if there are direct cost, then the gross profit, then the operational cost, and then we arrive at the EBITDA and EBITDA margin. Now, look at in this example, which is a hypothetical example, I have taken the projection of when we are looking today. So till 2023, the last 5 years and the next 5 years. This is this is a ideal kind of the financial information which we require for valuation. Now look at in FY19, the revenue was 100 crores, FY20 the revenue was 110 crores, and FY21 revenue dropped to 16.5 crores, which is kind of the only 15% of the revenue of the previous year. Why? Because it was a COVID year and significantly impacted. Then FY22, there is a recovery in FY22, and then FY23, there is again a recovery, but still behind the COVID, pre-COVID year. And then FY24. Now FY24 is 115 crores with a million, which is in line with the pre-COVID numbers. Okay. FY23 has to be the actual numbers because the year has already been closed. Now, look at, if you see, in a normal situation, if I look at the business, in a normal situation, if there would not be a COVID and the growth in FY23 to FY24, the growth is more than 50%. Can we consider as 50% is a reasonable growth in any of your forecast period? Yes, but it has to have a reasonable basis and assumption behind it. Why 50%? When the historical growth has not been a 50%. But in this particular case, you can accept that growth in FY24 and compared to FY23 can be 50% because there is a specific factor to it. That FY23 is still lower than your pre-COVID year, and the market may not be recovered in FY23, but FY24 can be considered to be a pre-COVID or COVID neutral year. And then you can consider that it will be a normal year, and then after you can consider as a constant growth parameters. So in this is something reasonable to consider. If it would not be a kind of a situation of the recovery from the COVID, definitely we have to flag as a valuer that 50% growth in a particular year, when there is normal growth of 10, 15%, 50%, there has to be a basis for this. Now, why I'm saying you? Because in every projection, there has to be a reasonableness. And when you compare a reasonableness, you need to evaluate, find out whether the management has considered it reasonably fair for the projection. Because the valuation is going to be impacted by the forecast. Then look at certain examples like gross margin. Pre-COVID gross margin was 45%, 47%, and then COVID gross margin 21%, 22%, in 21, 72%, 66%, and 56%, 58%. Why? There may be a specific reasons to this, because revenues significantly dropped. There may be only those products which are sold which has the higher margin, and other products which has lower margin, or which has higher contribution to your sales, could not be, based on the demand from the market, dropped significantly. And this is specific to the specific products which are in demand, and you could sell in the market at the higher value, because there may be a scarcity during those periods. So the value or the margin is higher. And then FY24, your margin is somehow stable to 50%, 51%. It looks reasonable now if there is a justification. Then you constantly maintain a margin 59%. These are certain parameters which every valuer has to look at into the valuation. Then you move to the, let me give you another example, like operational cost. In FY19, operational cost was 10, 11, and then significantly dropped to 7. What may be the impact? What may be the reason for this? It may be a reason that those specific cost or cost rationalization measures been taken during the COVID. Maybe certain real estate properties been rationalized, certain employees has been churned around, or certain inefficiencies has been dropped from the business to be a long term, and those inefficiencies will be dropped for a long term period. Okay, and those benefits will continue to be there. So even if the operational cost, your business is revived, your operational cost has been into the same levels. This is again to be a reasonable assumption. And then you arrived at a EBITDA margin. Now EBITDA is ranging again from 45 to 44%. Here, the important aspect, why I'm saying these parameters, because estimating a cash flow and accepting from the management, there has to be reasonableness in the cash flows for valuing the business. Then look at other income, which is constant kind of the income on the surplus of the funds available in the bank FDs, in the mutual funds. Then depreciation so it's a small kind of a depreciation, may not be a capex kind of a business. PBT, then tax rate which is applied, and then you arrive at the PAT margin. Okay, and then typically a balance sheet which is reflected based on your parameters. And then you arrive at a cash flow based on the available information. PBT, then interest income which is added, you arrive at the cash flow from the operations, then cash flow from the investing activities, primarily the capex. Okay, then from financing activities, if there is any, and then you arrive at the cash flow. These are certain key ratios which are considered for valuing a business. What are these? Let's say revenue growth. As I mentioned, revenue growth in FY24, it's 50% in compared to FY23, which has a logical basis. And then thereafter 10% increase. Then look at gross margin, which is 51%, then continuously 50%. It's a within the range. EBITDA margins, PBT, EBIT margins, and the PAT margins, and your cost, variable cost structure to the cost. Now, this is how you look at the projection submitted by the management, and if there is any unreasonable, you need to make those unreasonable parameters and find out and see or analyze that if there is any kind of rationalization required over there. Then let's move to the DCF. In this, the cash flows from operations, which is coming from the calculations, capex, and then future cash flow from the for the firm. In this, maybe capital structure is not considered to be equity and debt; it is only a equity, and then discounted cash flows. So then discount rate. Now in this, first you need to calculate the terminal value. Terminal value is based on the Gordon's formula. Let's say 15% is the cost of equity and 5% is the growth rate, and this is 15%. And then you applied the next year cash flows divided by KE minus G, and you arrived at the terminal value. Then you apply a discounted factor. Discount factor is for the first year is 1 divided by 1.15, and then for next periods, and the last year discount factor is 0.5, and terminal value is at the end of the year 28, and the same discount factor will be applied for the terminal value. Present value, you applied discount factor and the free cash flows, and you arrive at the enterprise value. Enterprise value is the value of the business, regardless of your available funds, regardless of your capital structure. In this particular case, if we do not have any equity, then enterprise value is equal to your equity value. But in this particular case, calculation of the equity, there has to be consideration of the cash. So any surplus will be added to this business. So for calculating the equity value, you need to add or less first the capital structure adjustment and then any surplus cash available. So total value will be 527. Now, this is how a typically discounted cash flow method will be applied. Now we have a short time. I'll quickly go on the multiples. In this sheet, there are 10 comparable companies which we find in a space of this kind of a business. First, A, which is a enterprise value of 5,000, sales 625, and then multiples are given 8 and 25. Now look at the company where you have your sales for FY23 in the range of 77 and FY24 150. First, you need to compare the company which is within the same size and same geographies and same which has similar kind of the patterns. In this, first company can be considered to be outlier because it has a large size compared to your company. 625 is the sales, which is more or less 8 times of the company which we are valuing. It has to be considered as an outlier. The next is 83, can be considered as the comparable company. Then next company, which is 167, again it can be considered as the outlier because it is still has the higher value in terms of the turnover, but can be considered within the range if not available other comparable companies. Next, which has a sales of 80, can be considered. Then the next company, which is E100 in sales, which is similar kind of a size of the company. Then 109, which is again a similar kind of the size. Next company, which is 50, which is significantly lower than the business you are valuing, can be considered as outlier. Then next company is again to be, this need to be again considered to be outlier because it's again in the size, it's very small. Next company, which is again a very small and EBITDA is negative, can be considered as outlier. Then next company, which is again a small size, can be considered to be the outlier. Now, those outliers cannot be considered as the benchmark, and the remaining companies can be considered for the benchmark. In the benchmark, if the other than the outliers, if we consider, sorry, this is not the outlier. And if we remove all those, we consider these the remaining companies and apply the average multiples, EV sales, EV EBITDA, then we can arrive at the average value of the business. Now you look at average business of based on the multiple, it is coming in the range of 377 to 467. We can consider the average of both 422 and then compare with the DCF technique. DCF is giving us the value 382, and based on these ranges from 382 to 422, average again can be considered for the valuation purpose. So this is all which I wanted to convey today in the methods and approaches. This is a very vast topic and need to refresh, need to have detailed study and look at what are the things are going in the international market, because valuation is the most evolving field in today's scenario, and this is going to be a big opportunity for the professionals. So with this, Indrajit, if there is any other questions which you want me to take, or we can just close this. This is all from my side, and thank you so much.
We have some questions. You can ask one or two of them. Question I would like to ask: will this discounted rate of return can be used in case of government companies, as there will be lower or nil risk?
This is not so. It is based on the risk profile of a company, okay, and the beta and the beta. So generally, the government companies cannot be considered to be zero risk. It is only a government securities which we see that government is committed and will provide the security in case of any default, because there is a government guarantee. But the government company does not guarantee any dividend, does not guarantee any profitability, and there is always a risk in the business. Definitely, the beta of those government or the public sector undertakings will be lower than the other businesses. So their discount rate may be lower than the other companies for discounting, but definitely it will not be a 0-1 or a low risk or a zero risk.
So next question, can you please elaborate which valuation method is to be used under Companies Act and Income Tax Act, and whether same to be valued either by a CA or a valuation professional? As I understand that DCF valuation can be done only by a valuation expert.
No, so again, the valuation requirement under Companies Act and Income Tax Act. When we talk about Income Tax Act, it refers to the merchant bankers, and in one specific requirement, it mentions to the registered valuers. But in case of the Companies Act, it can be by the CA, practicing chartered accountants, and the valuers. So this is a regulatory requirement, and registered valuer is not mentioned in the income tax, which I think there will be some the valuation standard board and other members are also following up, and maybe the changes will come up with the direction from the ministry. It is not as of now, but discounted cash flow method has been the accepted at everywhere. It is not specific to the income tax act or not to specific to the Companies Act. Discounted cash flow method has been accepted in all the statutes.
So I hope we have taken so many questions for this session, and thank you, sir. Thank you, CA Vikas Kumar Goyalji, for sharing your valuable knowledge and expertise with us today, and your insights have been invaluable. And we all appreciate your dedication to the field. And my sincere gratitude to each and every one of you for your gracious presence and invaluable contribution by asking such questions. And really thankful to the chairman and vice chairman of the board and every team members who make this webinar every Sunday successful. So your presence and insights have enriched our understanding and deepened our appreciation of this important subject. And thank you everyone for making this webinar successful. And I would like to announce again that we have a feedback form for all the participants. So please do fill that feedback form that is on the right side of the webcast. So thank you everyone and have a great day.